All right, welcome everyone. We are very excited to have you with us today. My name is Daniel Blake. I'm the CEO at UI Charitable, and I'm here with Brett Wayman, the managing partner at Overlay Capital. And we are going to be talking about how you can multiply your impact with a donor advised fund. Brett, is there anything that you'd like to say before we jump in?
No, I just appreciate the opportunity to be a part of this webinar, Dan. It's great to work with partners like you.
Yeah, absolutely. This is a really fun topic. Well, let's go ahead and jump into this. And so, in talking about impact, I want to talk about why you should consider a donor advised fund and why you, as a financial advisor, should care about this. So, there was this benchmarking study. It's a couple years old, but from all of the subsequent data that I've seen, these numbers still hold true. Um, they were looking at 1,200 RIAs and family offices and comparing those that included charitable planning compared to those that did not include charitable planning in their service offering. And I think these stats are really compelling and serve as a really strong business case as to why you should incorporate charitable planning, with impact investing being a part of that, into what you offer. And so firms that offered charitable planning had 6 times the median assets compared to those that did not include charitable planning. They saw 3 times the amount of organic growth compared to those that did not include charitable planning. And I think most compelling when their clients were asked the question, do you view your financial advisor as a multi-generational resource to your family? They scored 27% higher on a net promoter score compared to those that did not. And so as we see just a tremendous amount of wealth moving from one generation to the next, um, charitable planning, talking about philanthropy, incorporating that into your practice is one of the most important things that you can do to create a sticky relationship from one generation to the next. And one of the biggest trends that we've seen, especially with these younger generations, is how much they want to focus on philanthropy and how much they want to focus on impact investing. The fact that they want to align their personal values with their financial portfolio. And so the easiest way, I would argue, to incorporate charitable planning and philanthropy and impact investing into your service offering would be through donor advised funds. And we'll talk a little bit about what a donor advised fund is and how they function. But just a couple of quick stats. The average DAF size is just under $200,000. There's currently $234 billion held in donor advised funds. 10% of all philanthropy in the US comes from donor advised funds. Donor advised funds are very popular. They're very mainstream. You can find DAF hosts at Fidelity, with Fidelity Charitable, Schwab Charitable, Vanguard Charitable, just about all community foundations across the United States host donor advised funds. But half of high net worth individuals still aren't familiar with the concept of a donor advised fund. So it's really interesting given how mainstream they are, how many different donor advised fund hosts there are, how much money is locked away in donor advised funds, this $234 billion. They are the fastest growing charitable vehicle currently, so very popular. But even then, 50% of high net worth individuals aren't familiar with a donor advised fund. And so there's still a tremendous amount of opportunity to better utilize donor advised funds. So let's get into really what is a donor advised fund. So a donor advised fund, you could think of it really as an alternative to a private foundation. If we go back to that previous slide, with the average staff size being right around $183,000, what a DAF is doing is it's giving everyone, regardless of how much money they've set aside for charitable purposes, the ability to have something that's similar to a private foundation. And so you can think of a donor advised fund really as a giving account. And so you, the donor, you're going to make a donation into your donor advised fund, which is held at a public charity, a 501(c)(3), and that donation is a tax-deductible donation. And so the moment that you make the donation to your donor advised fund, you are receiving that tax deduction. And then those assets sit in the donor advised fund, much like they would in a foundation. Those assets can be invested and they grow tax free. And then when you would like to, you can then grant out of the DAF to charities, social impact organizations. You can use those funds to fund whatever your charitable goals are. And so, from that sense, it's really the same concept as a private foundation. And the power of this is that you're separating out these two transactions by separating out the timing of the tax deduction from the timing of your grants to charitable organizations. You're able to optimize for both of those. And as a financial advisor, as somebody working in a family office, that then becomes a really powerful tool because you can look at the timing of the tax deduction and just optimize for that. And then separately, you can be really thoughtful and you can take your time and you can be really deliberate around what you want to do from a charitable giving standpoint. And those two decisions are no longer connected to each other. One thing that I will note with a DAF where it is different than a private foundation is a private foundation has a 5% required distribution minimum required distribution each year. A DAF doesn't have that minimum. And so if you want to give a lot of money away from your DAF in a year, you can do that. If you want to give nothing out of your DAF in a given year, that's also allowed. And so donor advice funds really are incredibly flexible, and they are much more tax efficient than a private foundation across the board. They're almost twice as tax efficient as a private foundation. There are three things that I would argue all family offices, all financial advisors should look at when looking at a donor advised fund. And one is what types of assets can you contribute? The second is how those assets are then managed. And the third would be what organizations you can give to out of the donor advised fund. So we're going to do a deep dive into each of these three buckets. But whether you are working with us or any other donor advised fund, I would strongly encourage you to look at these three areas as you're doing due diligence on the donor advised fund host. Because the IRS allows for donor advised funds to be incredibly flexible. But a lot of DAF hosts have placed internal constraints limiting some of the functionality of donor advised funds. Our goal at UI Charitable is to remove all of those constraints and to give as much flexibility as allowed by the IRS to both the donor and their financial advisor. And so let's jump into each of these three different buckets. And so this first one, accept a wide variety of assets. So most donor advice funds, just about every donor advice fund out there is going to accept cash and public securities. That's really easy. They all have a very simple process for that. For higher net worth individuals, some of these non-traditional assets are going to be really important. These are going to be some of the most highly appreciated assets in your portfolio. So private business interests, real estate holdings, cryptocurrency. We've seen a lot with oil and gas investments, and really kind of any other alternative asset. In the case of these non-traditional assets, you're going to see that different DAF hosts have different requirements. As an example with the private business interests, some of the larger institutions, Fidelity Charitable, Schwab Charitable, they do an excellent job with most private business interests, but they don't like dealing with S corporations. Real estate holdings, depending on how it's held, depending on if it's raw land or if it's in an apartment complex, they're going to have different requirements. We have focused on building very streamlined processes to accept any non-traditional asset, really regardless of what it is. And that process, in the case of cash or a public security, you're just donating those to a donor advised fund. It's a really straightforward process. In the case of non-traditional assets, generally we're going to craft what's called a gift agreement, and that's going to transfer the ownership of we'll use an LLC, for example. It would transfer a portion of that LLC from you owning it personally into your donor advised fund. And so when that happens, the DAF becomes an owner in the LLC, which, for the moment, is going to be an illiquid asset. You can't make any grant off of that. And at the time that the LLC sells or you liquidate whatever non-traditional asset it is that you're dealing with, that ownership then converts into cash. And that cash flows into the donor advised fund. That cash could be reinvested or it could be granted out to different social impacts organizations, or you can make an impact investment from that cash. And so at UI Charitable, again, we have really focused on building out our capabilities around non-traditional assets, making it really easy and very streamlined for donors to donate whatever is the most highly appreciated asset in their portfolio. So the second bucket is retaining control of clients' assets. At UI, we have a totally open architecture. And what this means is we've been able to remove all of the minimums. So regardless of the size of the DAF account, you can assign your financial advisor, your wealth manager, to manage the DAF, just like they're managing all of your other assets. We would then work with the financial advisor and we would set up a brokerage account at their preferred custodian. So if you want these assets held at Fidelity or at Schwab or Vanguard or Raymond James or Pershing, that's all fantastic. We want these assets to be managed in the same course of business as all the other assets that your financial advisor is managing for you. This then allows the financial advisor or the wealth manager to manage the assets in their same process. In the case that you have an investment platform, you can use all of the assets in the DAF to fund those investments. If you're charging a management fee, you can bill against the donor advised fund account the exact same way that you'd bill against any other investment account that you're managing. And perhaps most importantly, especially as we dig into impact investing, there's the added flexibility that you can make alternative investments out of your DAF. And so in the case that you are wanting to make an impact investment, that is absolutely allowed. And we think it's really important that you as the donor or the financial advisor, you have the flexibility to manage these assets just like you would any other asset. And perhaps more importantly, that you can accomplish whatever your philanthropic goal is. So, where that includes impact investing, I think it's really important that donor advised funds are included in that conversation and that the assets in the DAF can be used to make these impact investments. So this third area, we're going to kind of go a little bit deeper on that last comment on impact investing, is looking at the broad range of giving options for a client's philanthropy. And so at UI Charitable, we allow individuals to make grants, recoverable grants, loans, equity investments, impact investments, both domestically and internationally. And if we dig into this, what's really interesting is this also means that using your philanthropic tax-deductible dollars in a donor-advised fund, you can support both nonprofit organizations as well as for-profit social ventures, for-profit businesses that are making money, but that are addressing and solving social and environmental problems. And depending on the profile of the nonprofit or the for-profit, you might decide that a grant makes the most sense. If it's a group that's doing something to conserve the environment or working with the poorest of the poor, there might not be any financial returns. And so a grant is perfectly applicable. Or there might be instances where they're able to pay back the principal, or at least a portion of the principal of the grant or a very low interest rate loan. So we would consider that a recoverable grant. where there's this optionality of them, of the recipient being able to send back a portion, if not all of the grant. And when, again, you're working with the environment, you're working with the poorest of the poor, this becomes a really powerful tool. Or you can have a more traditional loan, more traditional equity investment. A lot of the impact investments that we deal with are going to be focused on more traditional loans and more traditional equity investments. And again, most donor advised funds, unfortunately, really are going to limit your giving to the United States. And there's a tremendous amount of need here locally. But there's just as much need, and we see, at least with our donor base, that a lot of people are interested in supporting organizations and causes internationally, in addition to their domestic work. And so we think it's really important that donors have the optionality to support both causes here domestically as well as internationally. And what you'll see with all of the work that we've done here at UI Charitable to make all of these giving options available, what it does is it makes a DAF look and feel as though you have a fully staffed family foundation. You're deciding what you want to do, you are establishing the strategy, and then we go to work in making all of that possible. And so in the case that the IRS does require additional due diligence, they acquire additional expenditure responsibility, our team here will do all of that on your behalf. And so we really think of ourselves as a philanthropic back office for family offices and independent financial advisors. And again, our goal is to enable our clients to accomplish whatever it is that their philanthropic goals are. And more, we're seeing that impact investing is becoming a focus of their philanthropic goals. And so I'm super thrilled to turn the time over to Brett to really take us into a deep dive into the world of impact investing.
Thank you, Dan. What a privilege to be here and to be able to share with you all a little bit about what we're doing here at Overlay. I just want to kick it off by saying that the DAF environment is underutilized. This is something that we've been aware of for the past 10 years or so, just the availability of the donor advised fund structure, and it still is not being used as often as it should be. So we couldn't be happier to be here and to talk about what we're doing and the availability through UI Charitable. Overlay Capital at its heart is focused on advancements within the built environment. We are really focused on investing across the asset stack, from innovation, which is early stage climate tech companies, through infrastructure, which is more lower middle market private equity. We believe that there's been a mega shift towards sustainability. We think it's one of the key themes that we're seeing in investment opportunities to date. But along with that mega shift comes the opportunity for superior risk-adjusted returns. So on the spectrum of impact investing through market rate investing, everything that we look at is through the lens of sustainability, but we are focused on the investment opportunities, the return opportunities for investors. Now, why built environment? If we look at the CO2 emissions and the climate impact broadly, we see that over 40% of annual global CO2 emissions come from built environment, things like land and buildings and structures, utility and energy infrastructure, and transportation infrastructure. Most importantly, though, and most surprising to me when I saw the stat, was that 75% of the infrastructure needed by 2050 hasn't even started yet. So as you're thinking about where do investment opportunities lie in the future, we see it in the intersection of the built environment and sustainability. We're a team of 12. You can see that 8 of the 12 are on the investment team. So we've built our firm over the past couple of years to really represent an investor perspective, bringing together expertise from across the spectrum, from capital raising through investment decisions, through operations and fund support. So I want to talk quickly about 2 different investment products that are available through UI Charitable that we run here at Overlay Capital. One is our innovation fund. This is our early stage climate tech, water tech, ag tech focused venture fund. And the other is an infrastructure fund focused on infrastructure debt. I'm going to try and get through these quickly so that we leave a little time at the end for Q&A. But if you have questions that come up along the way, please enter them into the chat, or feel free to email Sarah or Dan, and they can respond to us. So within the Innovation Fund, what we are seeing is the reduction of cost and waste across basically every aspect of business. This is across industry, sector, geography, and it's really being driven by unit economics and by the decrease in cost, for example, of solar panels, which have decreased by 90% from 2010 to 2020 over that 10-year period, 85% in the reduction in the cost of lithium-ion batteries, the reduction in cost of renewable energy generally, so that it is on par now with traditional coal energy production. And we're seeing a whole range of new technologies that are entering into this, what we think of as the plateau. Now, I know plateau generally has a bad connotation. For us, though, what that means is that there is parity in unit economics, that it is now affordable to invest or to implement these technologies at a scalable level. That's not true of all climate technologies. Things like nuclear and wave and tidal power are still early in the development phase, but we still expect those to be commercially scaled and available within the next 10 years. Those are the types of investments that we really want to be focused on, not the ones that are at the far right of what we call this hype curve that are already better, cheaper, and faster, but the ones that are innovating towards being better, cheaper, and faster. We're also seeing innovation being driven by large corporations and municipalities who have tons of dry powder that know they need to innovate around sustainability. They need to hit their net zero targets. They need to hit their sustainability goals. They're often not developing these internally. What's happening is they are investing in third parties, new startups that are promising sustainability related solutions. And as those solutions play out, and we can prove that they're working in these pilot programs, these early adopter programs, they are then acquiring these companies rather than trying to redevelop them internally. We think there's an immense opportunity for that reason for these earlier stage companies, specifically in sustainability, where we don't tend to see it in things like software and hardware development. Now, the strategy itself is diversified, low fee, low minimum. We do that specifically because at Overlay, our whole goal is to be able to provide access to high quality, institutional type, climate related investments in the private market. In order to do that, we've allocated about 35 to 50% of the portfolio to funds that help to diversify our exposure, but that also creates access for us to these really high quality, high demand co-investment opportunities. So some of the funds that we invest with, for example, Lower Carbon Capital or At One Ventures, are two of the 5 funds in our portfolio. We've negotiated with them access to all of their co-investment opportunities. These are highly curated, highly sought after, but we're able to get them into our portfolio because they come through our fund partners and at almost no fee. That helps to decrease the fee across the entire portfolio. So what you end up with is a portfolio of around 35 to 50 investments total across the funds and across our direct allocations, leveraging top managers like Lower Carbon Capital, where investors typically can't access directly. They're typically the purview of large institutions like endowments and foundations and pensions, and to do it for an all-in fee that's less than 2 and 20. Now, the target for this fund is not a 10x or 100x or 1,000x. We're trying to produce a very reasonable 3 to 4x return in the venture space. That's about a 30% net IRR when you look at it across the 10-year fund life. Where we focused within the fund, focused on decarbonization, specifically the transition to net zero. We're focused on food and agricultural solutions. We're focused on manufacturing and the circular economy, where we're lowering cost inputs. And we're focusing on these because we know there's a trend and a drive towards reshoring our manufacturing processes and building, again, that 75% of infrastructure that has not even been started yet. Now, on the infrastructure side, we've recognized that there's immense tailwinds with the Inflation Reduction Act and the investor tax credits and producer tax credits that are affiliated with that, some of the government funding of new renewable energy projects, and have put together a product that plays at what I call the periphery of the grid, We are not a traditional solar or wind developer. We're not buying into the equity of these development projects themselves. We're providing debt to help catalyze more renewable energy generation. And what we have seen in the markets is that the investing in equity at the developer level is pretty commonplace now, and it's available through really all asset managers and in some form or fashion, whether it's through public companies that are doing renewable energy projects like utilities, or it's through large funds at Blackstone or BlackRock or Brookfield. Where we have heard from investors is that they're looking for four key things: diversification, enhanced returns, income, and downside protection. And that's how we've structured this fund. Now, what are renewable energy products? It may sound reductive, but a lot of investors think that solar is the only place to be invested right now. And we believe that solar is a really compelling investment opportunity, especially since the cost of these solar panels is decreasing, the availability of land for solar energy projects is increasing, and the know-how to build those is increasing. But there are also things like battery storage. And so where we tend to focus is across these two themes, solar and battery storage, but in what is called distributed generation. These are much smaller scale, sub 10 megawatt type project sizes. You could think about it as akin to lower middle market in the private equity world. What we really like about this space, and specifically in providing capital for things like interconnection deposits or project finance, is that we are often sitting at the top of the capital stack. So these are highly downside protected strategies where they're over collateralized for interconnection deposit investing, which is a whole nother topic, which we'd be really excited to geek out on and share more about. The collateral that's held there is about 1.2x in terms of coverage. For a project finance, it's about 1.5x. So we have access to collateral that is worth way more than the investment itself. And we also sit at the top of the capital stack for any income or return of the deposits that are paid back to the developer. Now, even if the majority of the projects don't go through, and this is definitely not what we anticipate, but we always like to show the downside here. If 100% of the projects are completed in this fund, we'd see about a 17% IRR over the 7-year investment period. It's about a 1.6x return on capital. Even if in the worst case scenario, we're seeing only a 40% project completion scenario, we're still, because of that over collateralization and because of the partners that we work with, seeing almost a 15% IRR and over a 1.5x return on the invested capital. And just to put this in the context of where this fund itself sits related to other investment asset classes, we are much lower on the volatility scale because this is private debt. It's secured by interest that's paid to overlay by the developer. But the asset return, because of the over collateralization and because of the scarcity of capital for these types of loans that we're making in the private credit space, we're much higher in potential return. Now, as an investor, this is definitely that top left quadrant of this chart is where you want to be. And that is certainly where we're focused. So with that, I'm going to wrap it up and turn it back to Dan to round out the presentation and see if we have any questions.
Yeah, Brett, thank you so much. So we are coming up on the 30-minute mark, but maybe we have time for just one or two questions. Sarah, I believe you've been collecting those.
Indeed, we have received a number of questions, and I'm going to start with one for Brett, if I may, which is, my clients are new to private investments. What should I be thinking about in investing in alts?
That's a great question. So the thing that I generally advise here is look for gateway investments where they're much lower minimum. You don't want to be putting, investors into $1 million minimum product if it's their first time in privates. It's why we've reduced our minimums to $100,000. And also ones that have some sort of income component to it. I think if you're new to the space, you want to really be focused on seeing the benefit of being in that investment through quarterly income generation rather than having to tie up your capital for a really long time and being uncertain.
Brett, another follow-up question, which is the two funds that you featured, or the two investment opportunities that you featured, are they still both open?
They are
Or
still open. Yes,
Okay.
that's a great question too. The Innovation Fund will be open through the end of this year, and the Infrastructure Fund through Q1 of next year.
one last question for you, and that is, how do you go about measuring impact?
Yeah, that's a fantastic question. For the Infrastructure Fund specifically, we work with a third party called Proof. It is a platform-based impact measurement firm of which we've been affiliated for many years. And they're looking at not just the environmental impact, but the social impact of the solar projects that we're doing. How does it really support things like community solar, things like giving back energy production to local communities, and helping empower marginalized communities to move towards renewable energy. On the Innovation Fund, because the investments are so diversified, there's no one easy measure, but we do measure the impact in terms of both decarbonization, the amount of carbon that's taken out through the new technologies that we're investing in. I'll leave it at that. We do have quarterly commentaries that we put out that talk about the impact of each of those, but I want to make sure leave room for time here.
That's awesome. And Dan, here's one for you, which is, does the UI DAF accept alternative assets?
We do, yep. And so in the case that you are invested in alternative investments or assets, and you would like to contribute those to your donor advised fund, we absolutely do accept those, and we have a very streamlined process to accept those.
And what happens when I want to grant out of the DAF, but the holding in the DAF is illiquid?
Yeah, so if you don't have any liquid assets in the DAF, you are going to be limited in the grants that you can make. Most social impact organizations, whether it's a for-profit or a nonprofit, they want to receive cash or something that can be turned into cash very quickly. And so if there's an absence of cash in your donor advised fund, you're not going to be able to make any grants out of your DAF until you liquidate whatever holdings it is that you do have.
And with regard to the tax benefit of making an investment in an impact fund like overlays, how would that be double counted, or is it just one tax benefit of making that?
That's another really good question. So you only receive a tax deduction when you contribute into your donor advised fund. So that's any contributions into a DAF qualifies you for a personal tax deduction. But then the assets in the DAF can be invested and they grow tax free. And so when those investments are liquidated, the assets in the DAF are not subject to capital gains. And so there is some ongoing added efficiency from a tax standpoint with any investment that's held in a donor advised fund.
One last question about a donor advised fund, and that is, what happens to the donor advised fund if it has not all been distributed upon the death of the original donor?
Yeah, donors can create a succession plan. They can either pass it on to their children and let the DAF exist in perpetuity, or upon their passing, they could grant out any remaining funds to the charities of their choice. And so there's a lot of flexibility in creating a succession plan.
So those are all of our questions for today.
Awesome. Well, Sarah, thank you very much. Brett, it was a pleasure as always to have you on and to learn more about impact investing. And for all of you in attendance, I believe Brett had shared his contact information on his last slide. If you have any questions about donor advised funds, our website is uicharitable.org. My personal email is danblake@uicharitable.org, and I'd be more than happy to answer any questions that you might have. So thank you very much.
Dan, thank you for the opportunity. Really a privilege. Thank you.
Absolutely.